Now, it was certainly not welcomed news for consumers. Inflation accelerated in January with the cost of groceries and gas and used cars all rising. And to break down what this all means, we are joined by the president of the Armstrong Advisory Group, Mr. Mike Armstrong. Mike, thank you for being with us.
Hey, good afternoon. Thanks for having me.
So we want to jump right on in here, Mike. We are back to an annual inflation rate of 3%. That's the first time since June. Why was this such a surprise?
Look, I think, we've got to gauge these things. It wasn't a surprise in the way that, something coming absolutely out of left field is, but this was hotter than anticipated inflation, and you get a few more of these, and it could spell really bad news for consumers. This is one report. I want to put that in context, and equity markets at the moment, at least as of 2 o'clock today, are not selling off too dramatically. But bond markets are, and investors are very seriously questioning whether or not this economy is going to return to what the Federal Reserve deems a normal level of inflation anytime soon.
Now, Mike, the Federal Reserve is trying to slow inflation to 2%. Do you
Indeed.
see another interest rate hike in our future, and will this stop further cuts?
So an interest rate hike is not on the table right now. I don't think that there's any Federal Reserve member that takes this report alone and says we need to go higher on interest rates. As far as rates coming down anytime soon, I also don't think that's in the cards. If you get 3 more reports after this one showing repetitive increases in prices of 0.5% per month. And to be clear, that is what we saw on headline inflation, is prices up by 0.5% in the aggregate month over month. Then you've got something to talk about in terms of rates moving higher. If it dissipates a little bit, if maybe this is just a bump in the road, which, by the way, we saw a similar bump in the road in the first quarter of 2024 that didn't turn into anything, then, maybe rates just need to hang out here at these levels. But a few areas that concern me, obviously, food prices and egg prices, we're all quite familiar with those at this point. But, you saw energy prices up, and across the board, shelter costs, auto insurance, all sorts of commodities, as you mentioned, used cars and trucks, all seeing pretty substantial month-over-month increases. And those are the ones that the Fed and economists care a little bit more about in terms of developing a trend. And so this bears watching closely. We saw an employment report that saw the unemployment rate tick down further. And so by all accounts, this is a pretty tight economy right now. And if inflation goes higher, could lead to some problems.
And Mike, it's so good to have that perspective for people that are watching. Now, do you think this is linked to the new Trump administration tariffs?
It's a fair question. I think, one, we have to be clear about something. This is a measurement of price increases in the month of January. There were no tariffs in place in January, and so you cannot point to it and say, look, these price increases are going into place because of new taxes on imported goods. That wouldn't be accurate to state. Could you convince me, however, that some of the inflation we've seen in December and January is because consumers are worried about pending tariffs and what that could mean for future prices, and are therefore bringing purchases of things like used cars and trucks forward, and therefore driving up prices because of excess demand? Yeah, you might be able to convince me of that. And so I think it comes back down to the power of words and the power of expectations. And if people think that prices will go higher, then oftentimes they do. It becomes a bit of a self-fulfilling prophecy, and the Trump administration is going to need to treat that fairly delicately if they're not going to prompt more inflation.
Now let's talk about the Consumer Price Index report. What effect has that had on the stock market today?
In early trading, you had equities off by a full percentage point. At this point, they've calmed down substantially. The S&P 500, probably the best barometer of the overall large cap stock market, is down by 0.4%. The Dow Jones Industrial Average off a little bit more, and the NASDAQ It's pretty close to flat at this point. It actually popped positive for the day just a few minutes ago. I would consider the equity market reaction to be relatively muted, and I'm not sure what to make of that. If people are just convinced that this is a short-term blip on the radar, if they're convinced that, hey, higher prices aren't necessarily bad for companies who are able to very easily pass those prices along, or if there's just a little bit of whistling past the graveyard on this one. I hate to try and interpret single-day moves in the stock market. One thing is definitive, though. In the bond market, the interest rate on 10-year treasuries is moving up by a full 1/10 of a percentage point. That's a significant move in the bond market and speaks to, I think, some of those inflation fears for the future.
Now, Mike, this has all been really good stuff for our viewers. Is there anything that you would like to include regarding inflation that I did not ask you specifically?
Well, I think just the indication right now is that in spite of the progress made on inflation over the course of 2024 by the Federal Reserve and Jerome Powell, the job is very clearly not done. He indicated as such in front of Congress yesterday, and I believe is testifying today too about the same subject. And we just don't know what the overall effect of things like tariffs and deportations and other things could lead to in terms of the economy. And so these reports are important to get a sense of things. And this one, there's no way to paint it other than a bad inflation report that came in quite hot.
Well, Mike, thank you very much. We look forward to continuing to check in with you as time progresses. Mike Armstrong of the Armstrong Advisory Group, thank you so much for joining us.
Thank you, Courtney. Appreciate it.